will start now. I'm Jim Steiker from SES Advisors. We, of course, are a firm primarily focused on ESOPs. We provide both ESOP advisory services and record keeping and other related plan services. I'm also an attorney with Steiker, Fisher, Edwards, and Greenapple, a related law firm, and we provide legal services to ESOP companies. Purpose this morning's presentation is to talk a bit about what goes on in ESOPs that are going through, are recidivist, if you will, or going through or thinking about going through a second stage or additional transaction, having already at an earlier time become an ESOP company. Again, I'm going to encourage you to ask questions, jump in with commentary as we go along through the chat function. Make it at least know that people are out there as I speak into the phone here. And let's start here by talking about what is it that we mean by a second stage ESOP transaction. And what we're presuming is a couple things. First of all, we've already established the ESOP. We've gone through all of the plan design. We've thought about what it is that we wanted to do at first. And that ESOP has already acquired some portion of company stock. And we're now thinking about, we're going through the process of a new transaction in which the ESOP will, as part of the transaction, come to own a larger percentage of outstanding company stock that it currently owns. And so first of all, we have, if you will, the basic issues we've got for any kind of an ESOP transaction, which is, valuation and financing and basic rules. Valuation is, do we have a transaction price at which the selling shareholders, be it the company or individuals, are willing to sell and transact at? There's some agreement there. And do we have an ESOP under the advice of an independent appraisal that is comfortable purchasing at a proposed price? So do we have a price agreement among the parties? This is a consideration, obviously, for any ESOP transaction. Second issue, of course, is do we have financing for the transaction? Does the ESOP somehow have existing funds? Is there financing available either directly or more commonly via the company, either from a third party such as a bank or other financing party, or perhaps from the seller to allow the ESOP to make this additional acquisition of company stock? And thirdly, have we considered the basic constraining rules for ESOP transactions in putting together this transaction? Do we know we will be able to contribute to the ESOP appropriately within the limitations, contribution limits of 404A, not violate the allocation rules of 415, and comply with other applicable rules, particularly things that may apply to S corporations such as 409P, making sure we don't end up with non-allocation year and all of those other bad things that you probably have heard rumor of. So these are basic considerations in planning and structuring any ESOP transaction, and they certainly apply in a second stage transaction. We then have a set of issues that we probably thought about the first time around that we're really not thinking about this time around in a second stage transaction. And that's, of course, first and foremost, the threshold decision that the ESOP is a good direction for the company and a good direction for the individual shareholders who may be considering broadly issues about liquidity and succession in the company. We may be having a debate over how much the ESOP should own, but the ship has sailed in terms of deciding that the ESOP is an appropriate direction, unless there's also an alternative being considered, of course, to terminate the ESOP. The second thing we're not commonly seeing in a second stage transaction is a minority interest discount that might apply on the ESOP's acquisition of a minority interest in company stock. Most of the time, in a first stage transaction, the ESOP has already acquired a minority interest in company stock with whatever planning and structure that was involved. And usually we were talking about the ESOP going from being a minority shareholder to having more than 50% of the outstanding company stock. We do sometimes run into the case where you have an ESOP that was started perhaps with 30%, and the goal is maybe let's take that up to 49%. And in that case, we still do wrestle with the minority interest discount issues and the structure issues there. But that's a fairly uncommon transaction. Most of the time we're dealing with a change of control transaction. And finally, usually in the first transaction, we've done a fair bit of education of the individual shareholders, the officers, the directors, key people in the company, and perhaps some employee education about the ESOP. So it's not a brand new idea. It's not something we haven't thought about, and we have to tell people a whole lot of very basic information. We're hopefully dealing with folks who have some working familiarity with the terms and constraints that we generally discuss in ESOP transactions. And finally, often in a first stage transaction, we've looked at whether and how and why to perhaps convert from an S corporation to a C corporation when we wanted to deal with gaining the advantages of Section 1042 capital gains deferral, and we wanted to look at the use of convertible preferred stock. Typically, if we are a S corporation, by the time we're looking at a second stage transaction, it's unlikely we're looking at converting to a C corporation at that point. We're probably likely to want to remain an S corporation. We may be looking the other way, and we'll talk in a few minutes about what's involved in converting from a C corporation to an S corporation, but typically the S to C issues have either been done or at least they're off the table right now. So all of these are occasionally issues that might come up in a second stage transaction. But by and large, we've dealt with this set of issues the first time around, and it's not really where our attention and efforts are focused. So then we ask the question, well, what's different the second time around? Why don't we just take, the process and documents we did last time and do it again? The common belief perhaps is that maybe this is the easy thing to do, is to do it the second time after we've already done with it once. And our experience is that that's not really the reality. Usually the minority interest transaction, while it may have had a fair amount of thought process about whether to become an ESOP company and what's involved, isn't really the fundamental decision about the direction of the company. Again, we typically have individual shareholders who still own a controlling interest in the company, really still control the direction of the company, could make a decision at any time to sell the company to a third party or decide that the ESOP's got as much ownership as they're already comfortable with. And now they're contemplating what is probably a more complete and significant liquidity transaction, and also sort of a last bite of the apple, if you will, for shareholders in terms of changing from having been a controlling shareholder with all of those specific rights and having been utterly in charge of the company to contemplating being not a shareholder anymore or a minority shareholder with a different set of rights in an economic transaction that may be the last big hit that they get as shareholders. So these are typically change of control transactions, and that's not only in the literal sense, but also in the mindset, if you will, of the people who are thinking about selling. We also have some specific concerns, perhaps, about repurchase obligations in connection with the stock that the ESOP already owns. We know that when we do a new transaction and we give stock to the ESOP in a new transaction, it's going to take a good while to allocate it. It's going to take a while for people to become vested if it's a new ESOP. But when we already have an ESOP and we're looking at a second stage transaction, we know we may have some liquidity demands from the stock the ESOP already owns. We may have people who are already vested. That stock is usually fully allocated, and these are folks who may leave, retire, die, become disabled, do the things that would get them to the pay window and trigger repurchase obligations in connection with the existing stock. Also, in a second stage transaction, we're often focused on getting to 100% ESOP ownership, sort of the holy grail of being an S corporation ESOP, where we would love to be in the situation where all of the income of the corporation is attributed to the shareholders for tax purposes, and our sole outstanding shareholder is a tax-exempt pension trust. So if we can get to 100% ESOP ownership, we want to get there because we'll be effectively on a current basis a tax-free company. So a lot of times where in the absence of tax and other constraints, we might be going from 30% to 51% or 70% or 80% and keeping some individually owned shares outstanding. There's a pretty big push in most of these transactions to get to 100% ESOP ownership. And in fact, you really won't find in nature too much in the way of 70–80% ESOP-owned companies where people really thought about what they were doing fairly carefully, because we'll run into the issues of having individual shareholders who are being attributed taxable income and have to pay taxes, and having a controlling shareholder that doesn't have to pay taxes and doesn't need distributions. So in order to get to 100% in a transaction context, we're often looking at a decent slug of seller financing to bridge what we can't get from a third-party lender. And typically sellers who are providing financing are often focused on the nature of the return in holding seller financing, hence the idea of using warrants or other things to enhance sellers' returns, and we'll talk about that in a little bit. And we're also wrestling with the control issues, because very often we may be going from 30 to 100% or some lower number to 100%, and we know that we're having a change of control transaction from the perspective of stock ownership. But at the same time, we've got some concerns that a good part of the capital structure is still being provided by the people who used to own stock. They're now simply holding notes, and often are or ought to be unwilling to all of a sudden have no say-so and no rights in the corporate governance. So we're really wrestling more in these second stage transactions with the seller financing that's likely to be part of it and the return and control issues associated with the seller financing. Stop a second. Anybody have any questions they want to enter in through chat? Anything they want us to pay attention to as we get through this part of the presentation? So let's go on to some of the other issues that are coming up that are different about second stage ESOP transactions. We have to consider what's the implication of what we're going to do on the existing ESOP accounts, especially because we're likely to enter into a leveraged transaction, and that's likely to impact the value of the stock. Simple example, imagine we have a company worth $10 million, and we know it's worth $10 million because that's what the appraiser is telling us. ESOP owns 30% of that company. Individuals own 70%. If those individuals sell their 70% of the company to the ESOP, typically the company's going to finance it with $7 million of debt. Our new structure is going to be $3 million of equity, $7 million of debt. However, the ESOP's going to own 100% of the stock now, but 100% of the stock is going to be worth $3 million instead of 30% of the stock being worth $3 million. So from the perspective of the existing shares in the ESOP accounts, they're going to have a rather significant drop in value as a result of this leverage. And very often what we want to do is to protect the ESOP participants, particularly one of those that are near retirement age, somewhat from that drop. So we may look at price protection of some sort for the existing ESOP accounts. And this is an issue we're going to wrestle with a little bit. And we'll talk a little bit later on, how we might do that. But a couple of highlights on the price protection point are, one is we certainly want to make sure that that price protection doesn't protect people from the vagaries of the economy and company performance, but rather solely from the impact of the leverage. So we're going to focus our price protection here on saying, let's look at what the company would have been worth without the new leverage. Let's not just provide a floor price that says it's worth this no matter what happens to the company. Secondly, we're not going to provide it forever. We'll provide it maybe for 2, 3, 4 years while the leverage is having the greatest impact. And thirdly, when we look at price protection, we may only look at people who leave the company for death, disability, and retirement. We really don't want to necessarily be an insurer of value for people making a voluntary decision to leave the company. And price protection is one of the ways where good intentions have gone awry for some companies, because if we don't do these three things I mentioned, if we just simply say, let's have a floor price of X dollars a share, there's been a couple situations out there where companies did that. Company performance tanked. A lot of people got laid off as company performance tanked, and those laid off people were entitled to a valuation that was no longer sustainable based on company performance. So price protection is a case where good intentions are a good thing, but they need to really be thought through in terms of driving this issue in a way that makes sense and doesn't create these other sets of issues. We also want to focus a little bit on the have and have not issues for new and younger participants. We'll talk a little bit later on about structure, but a lot of times in a second stage transaction, we may or may not be having the ESOP purchase additional shares. We may sometimes be simply redeeming the shares and making the ESOP the 100% shareholder by simply having the company buy back shares that the ESOP doesn't own. And of course, what does that do? That promotes the people who already have allocations in the ESOP from being minority shareholders to owning all of the shares. It doesn't really create the availability of new shares for people who have joined the company later or may join the company in the future or may become larger players in the game. And so one of the things we want to think about is whether and how the ESOP should be acquiring new shares as part of this liquidity transaction, whether we should be having the ESOP purchase shares from the individual shareholders or whether we should be having the company redeem the shares. And related to that, we want to see what our ongoing benefit levels are going to be. And this again goes to whether the ESOP should buy shares, how much, and how fast they should be allocated. So we may want to have, for instance, a longer internal loan to allocate the shares that the ESOP is acquiring than the term of the financing we may be paying on the outside loans to banks and or sellers. Remembering that it's particularly as we are doing in most of these transactions where we are going to 100% ESOP ownership, we're really no longer guided in our structure by the need to get tax deductions. We don't need to make contributions and pay an internal loan in order to drive tax deductions to drive down our taxable income, being 100% ESOP-owned S corporation. So we can really have a sort of designer structure, if you will, where we figure out how fast we want to allocate the shares, how fast we make contributions, and what shares get allocated to new people over what period of time. And again, this is a complex discussion with a lot of interacting variables that one needs to think through. We also want to focus a little bit more carefully on management compensation and succession. Most of the time in a first stage ESOP transaction, we really haven't done much to change the management and operation of the company. If we have a founding entrepreneur or entrepreneurs who have sold shares into a minority transaction, typically those folks have remained in practical charge of the company as well as having the legal control of the company. They are often still the people who are the chairman, president, CEO of the company, and we really haven't focused on succession. Now, very often, we are doing a couple things. We are really having a succession set of processes as well as a liquidity set of processes. We may have new management emerging or coming in. We may have existing founding entrepreneurs going from being more of an activist CEO to being a perhaps less executive or non-executive chairman of the company. We have to figure out how to incent, reward, and retain key management. And these management compensation issues change as we're going from being a entrepreneur-dominated company to an ESOP-dominated company. So these are, very often we're looking at some management compensation devices to give key management an enhanced stake in the company. Only rather than using the more traditional stock options, which might create outstanding stock, which we think is a bad thing in an ESOP, 100% ESOP-owned company, where we want the ESOP to be the only shareholder for tax purposes. We're often looking instead at things like stock appreciation rights or phantom stock or other kinds of devices like that to give management some enhanced piece of the upside of the company without creating necessarily outstanding stock. We may also have some new issues emerging as we do these change of control transactions with other financing and bonding issues for the company. Very often, key entrepreneurs who are majority shareholders have often over the years provided personal guarantees on company financing or personal guarantees on bonding when companies, particularly construction-related companies, and or we just may have bonding issues where we've had a dominant shareholder that the bonding companies were comfortable with. And now we have a key shareholder who may be selling some or all of their stock now to the ESOP and will not be majority shareholder anymore, may not be a shareholder at all. And those folks understandably are not very anxious to continue to be a guarantor of company financing or guarantor of company bonds or be a participant in those bonding and financing issues. And so we may, in the process of a second stage transaction, have to have some careful discussions and negotiations with the financing folks and the bonding folks to make sure it's in fact feasible and achievable to get the key people off. And our experience has been most of the time that has worked, and there have been times where it's been an obstacle or a barrier. We also, have the evolution of the company governance. When we're owned by a single shareholder in the pre-ESOP days, very often the board, the key management, and the shareholders are meeting when one guy or gal comes to the office and picks up a cup of coffee. And now we're in a world where we have the ESOP as the primary shareholder most often. We have selling shareholders still participating significantly in the capital structure as lenders to the company and or the ESOP. And we really want to have probably a bit more formal and more structured governance and review processes. And so all of a sudden we're looking at how to have a board of directors that will often have some outsiders on it, will provide some meaningful oversight, will provide some meaningful review. We're usually not signing on for a board that's going to be heavily involved in the day-to-day, but we are signing on for the notion of the board as stewards and an adult supervision or oversight, if you will, as the company goes through the transition. And again, this is often an education piece and a practical change for companies going through second stage transactions. So these are the kind of issues that are out there that are a little bit different the second time around and may not have really been very prevalent the first time in. So let's look at a atypical second stage transaction structure. It's not necessarily the typical structure, as there's often a lot of things going on. And again, let's take our simple example and imagine we have a company with a enterprise value of $10 million, and we know it's $10 million because our ESOP financial advisor is agreeing with or valuing it that certainly on an ongoing valuation basis. And let's imagine we had the ESOP already owning $3 million, 30%, or presumably ignoring minority discounts, $3 million worth of the company's stock. And, generically, if a company is worth $10 million, it's probably got a couple of $1 million of EBITDA. And so typically we might look at a second stage transaction to go from 30 to 100%, and we might say, gee, a bank ought to lend us about half of that $7 million. If they lent us $3 million the first time, they ought to be willing to lend us $3 or $4 million in this transaction. That won't get us to 100%. The sellers are going to have to hold some of the financing. So the first thing we'll do is we'll go out and borrow what we can borrow from the bank, using the collateral of the company and the credit of the company to do it. And that number can range from none of it to all of it, but usually is somewhere in between in a transaction like this. And so in my example here, maybe we've borrowed another $3 million from the bank, and the company now has $3 million in cash, has a note payable to the bank, provided collateral security interest on that $3 million of new debt. And very often, in a first stage transaction, we're almost always going to fund the ESOP with a loan to buy stock directly from the selling shareholders, knowing that we're going to need tax deductions, knowing that we're going to really like the idea for the shareholders perhaps of electing capital gains deferral when they sell to an ESOP. These things are sort of off the board in the second stage when we're going to 100% ESOP-owned S corporation, in that 1042 very often won't apply. Sometimes it will. And secondly, of course, we may not need tax deductions. So we're going to be looking at what mix we want to have of a redemption, where the company buys back shares directly from the shareholders, and what degree we want to have an ESOP direct purchase of the stock using money that's flowed through the company that the ESOP has borrowed. And typically when we want to give shareholders seller financing, at least that piece of it, we're often going to look at very strongly as being a redemption piece rather than an ESOP purchase piece. Reason being, if the company is issuing a note in payment for shares, we'd like to be able for that note to have some governance rights attached. We might want it to have an enhanced return for the selling shareholders in the form of warrants, which are like stock options that will give the shareholders a piece of the upside of the company. These are both those control features and those warrant features are reasonable compensation to shareholders for being willing to take back debt. But they're really also things that only the company can give. The ESOP can't give them directly. So we're probably going to redeem some shares in my example here. I'm going to have the ESOP buy some shares. So a simple version here might be for the company to redeem 40% of the stock for a note for $4 million, recognizing we had a $7 million transaction here. We borrowed $3 million from the bank. We might have the company lend the $3 million it borrowed from the bank to the ESOP in an inside loan that looks a little bit like what we did the first transaction, and then the ESOP pay over $3 million to the shareholders to get 30% of the company's stock. So at the end of the day, the company would have redeemed 40%. In this example, the ESOP would have bought 30%, but the ESOP would now be the 100% shareholder because the redeemed shares would go away. And there are many different ways to play with this in terms of the proportion of how much the ESOP is buying versus the company is redeeming, but this is sort of the rhythm of the transaction. It's highly dependent on the financing. It's highly dependent on a whole bunch of other issues. Again, what we're trying to manage is several things. One is when we redeem shares, we make the ESOP ownership larger as a percentage of the company. It's anti-dilutive, doesn't affect the value. When we have the ESOP buy shares through a loan through the company, it is not anti-dilutive. It does affect value, but it also creates new shares available for allocation to participants. And so we're trying to balance these sets of concerns out typically to make sure that we've got a transaction that achieves the whole set of goals. And again, this is where you're going to want to do some modeling and some perhaps mildly complex planning to make sure that you end up with a mix of valuation, shares to allocate, period of time allocation that works for the company, and the selling shareholders are getting a fair return on holding debt of the company when they're providing some of the financing. Again, I'll stop and ask whether there are questions, comments, things to say here, at least via the chat. Either I'm being clear or everybody is tuning out here. So under one of those two presumptions, I will keep on going unless there are any questions here on the chat. As I said, here are really the key structure issues. One is how much are we redeeming versus how much the ESOP is purchasing. That's probably the most critical decision we're going to have in planning a second stage transaction. And again, there's other different attributes. We like redemptions because they're not regulated transactions. They're not fiduciary transactions. We like ESOP purchases because they create more stock to allocate and give us a longer period of time to allocate the stock to people. Also, the more we have, in a redemption transaction, we have more concerns over repurchase obligations, because we made the ESOP, the allocated shares, a larger proportion of the ownership. If in our example before, where the ESOP owned 30% at the beginning, if we simply redeemed the other 70%, the ESOP now has 100% of the shares allocated to participants. And so certainly as the company repays the leverage, repurchase obligations are going to be a really challenging piece of things here, because we've already allocated all the shares. People can leave, and they've got a pretty big piece of the company going forward. On the other hand, if we, as we talked about before, if we do it all as an ESOP purchase, we're going to really knock down the value of the company, and we're going to have some price protection sets of issues. Got a comment on the chat from my good friend Bill Whitehurst, who I have not talked to in a long time, talking about the potentially conflicting roles of management in planning the transaction. And Bill's certainly highlighting that these transactions are often management-driven. One really has to look particularly at the, if management is different from the shareholders, is management planning this transaction in the best interest of shareholders or in the best interest of the ESOP? We've really got a conflicted board, if you will. In other words, imagine a board of directors looking at a second stage ESOP transaction where the ESOP is initially a minority shareholder and there's an individual owning 100% of the shares. Sometimes there's a tendency for the individual shareholders to really view the board, or to be the board, and view themselves as primarily working for the benefit of the individual shareholders, when in fact as a board they owe a duty to all of the shareholders, including the ESOP. One of the things we'll commonly see in boards, more sophisticated boards looking at these transactions, is hopefully maybe we have some independent directors, and we may be appointing a committee of independent directors to look at the transaction and make sure that it's good for and fair to all of the shareholders and not just some of the shareholders. Anyway, structure issues here. We're also looking at the term of the mirror or the inside loan for whatever the shares the ESOP is buying, recognizing that the term of that inside loan, we're pretty neutral from a tax perspective, but we're really certainly wanting to make sure that we allocate the newly acquired shares over a period of time that makes sense. And our own advice usually is going to be that that period of time ought to be longer rather than shorter, and that it ought to be tied to providing a reasonable benefit level and also to making sure that there are shares to allocate for a good long time for the benefit of new and continuing employees, that we don't allocate all of the shares too quickly. And so we're often seeing terms of between 10 and 20 years on these inside loans for the ESOP purchase portion of these second stage transactions. We are going to be focusing on the economic terms of seller financing, remembering that sellers, when they provide financing, may be providing financing that in some respects has attributes of senior debt, meaning there really are company assets and company could have borrowed it from a bank instead. We'll have some of the attributes of subordinated debt, mezzanine debt typically provided by people at very high rates. And thirdly, we may be providing financing that has attributes of equity, meaning it's fairly far down the food chain. And what we really want to do is figure out what the right rate of return from a fairness perspective is on the seller financing. And sellers may be willing to be a little bit concessionary, but typically we're seeing internal rates of return on seller financing usually in the 10 to 15% range. The way we're providing that return, by the way, very importantly, in a typical mezzanine debt provider, they typically want a high rate of fixed interest, 8, 10, 12%, and then a little bit of warrants to enhance their return. And that's driven by the fact that the company that is issuing the debt in a typical non-ESOP transaction is very sensitive to getting tax deductions for paying interest. And so they're concerned about interest deductions, and the offsetting income to the lender is okay. Here we've got a borrower, the company, the ESOP-owned company, that doesn't need tax deductions and so therefore doesn't need interest deductions. And on the other hand, we've got issuers of the debt, sellers, who may be more comfortable with a piece of their return coming from company performance rather than it all being fixed interest. So we'll often see in seller financing a low rate of fixed interest, which is ordinary income to the seller, and a high rate of warrants, stock options that will be cashed out by the company later, that will give the sellers a higher rate of return, but will give that higher rate of return in a manner that is primarily capital gains rather than ordinary income. So there's a high advantage. So in an ESOP seller-financed instrument, we're, if it's properly structured, much more likely to see something that has a low fixed interest rate and a high degree of warrants relative to a typical mezz debt instrument that is high interest rate, low warrants. One of the questions that comes in here that says, when selling shareholders carry debt in redemption transactions, doesn't the bank object to the company having a second major creditor? And the answer is no and occasionally yes. The no is usually when we have selling shareholders carrying debt, it's explicitly subordinate to the bank. It doesn't often come with a security interest. And banks historically have looked at seller debt in ESOP transactions as being a quasi-equity from the perspective of the bank because it sits behind the bank and doesn't impair the bank's security interest or ability to be repaid. The bank may want restrictions on whether the seller debt can be repaid prior to the bank debt. But typically the seller debt is also going to be interest only until the bank debt is repaid. We're not usually paying principal until we're done with the bank. We have seen a few of the money center banks in the last year or two that are having issuers with bank examiners coming back and saying, gee, we don't like the seller debt on the balance sheet, even though we recognize it's subordinate and we recognize it doesn't have an economic impact on us. We're having regulatory issues with this. But we've seen those issues be fairly isolated. We've been able to get our deals done and find plenty of banks who don't seem to be having this sets of issues. Last structure issue, and it goes a little bit to Bill Whitehurst's comment, which is when we're often having management, key executives who are or are not sellers, either one, wanting to get fairly significant packages of synthetic equity in these transactions. They want lots of stock appreciation rights, lots of phantom stock. They recognize that it has an impact on the value of the ESOP ownership. Obviously, from a selling shareholder perspective, the individual shareholders who have usually been the gatekeepers on individual comp, they no longer have a dog in the hunt. They've sold all of their stock, and really the question is, what's the economic impact of synthetic equity for management on the value of what the ESOP gets? And any trustee that's looking at this kind of transaction and looking at the value of what the ESOP is getting is going to have some opinions about what's appropriate levels of executive compensation are when they're dilutive of the ESOP's ownership. So we are going to have some structure issues and some planning issues around executive compensation. So here's a couple of comments, sort of what seems to work better or best, what some of the best practices are in planning these kinds of transactions. And first and foremost, what we're seeing is you really want to model out the redemption and ESOP purchase elements of the transaction to do a mixture of managing post-transaction value, dealing with a lot of the little effects of what we're doing, managing fiduciary sets of issues, and making sure that we still have plenty of stock to allocate to people. And of course, related to that, that we allocate it to people at an appropriate rate that really is an ordinary benefit rate to people. It's an appropriate benefit rate to people. So we really want to be looking at this. And again, side factors we're looking at. ESOP used to own 30% of the stock. Company was looking at minority discounts. Recognize we're going to see a bump in value on one side of the equation from the fact that the ESOP's now a controlling shareholder, and the shares that it used to own on a minority basis are now valued on a control basis. So we've got a lot of different factors to mix in, and we really want to model and look at how they interplay to get to an optimized transaction. There's not a simple percentage answer that applies in all times, but there's a recommendation here that you really want to look at this fairly carefully. The second thing you really want to do is with whatever shares the ESOP is buying, make sure they're allocated over a good long time. Again, target level of benefits. Also, the longer we allocate their shares, the longer we have unallocated shares out there, the lower our ongoing repurchase obligations are going to be. And so, again, this can be a tool to make sure we don't have lots of allocated shares allocated too fast, too much of the company being owned old and cold and subject to repurchase obligation based on the decisions of people to leave or retire. Next piece I would say is there's a great tendency to want to maximize the amount of synthetic equity for management and give it all out. And while the management team may look good and complete on a given day as we plan these transactions, remember there's a great tendency for folks to come and go, for companies to grow and need new key people, for new players to emerge. So even if we're going to have a set aside, 10, 15, 18, whatever percentage of outstanding stock set aside as synthetic equity available for management, strong counsel would be not to give it all out at once, to hold some of that back and recognize there might be some new players that emerge, some new people that you'd really want to reward with this. So that's a real planning consideration in these things. And we've really got now a couple of special situations, things that come up that aren't altogether common, but really do relate. And one of the common things we hear generally is the idea, as we've talked before, that individual shareholders may want to hold on to a little stock and not have 100% ESOP ownership, but may want to have some ongoing ownership. And we understand that that's a bad idea from a tax planning perspective, because when these people are going to have K-1 income, they're going to want distributions to pay their taxes. And by the way, so are, if they get distributions, so does the ESOP. And if we have a lot of cash leaving the company, we're destroying the underlying tax benefit here. But very often, we get to the situation where somehow the ESOP's gotten a lot of the stock, and we have some small shareholders who really don't want to sell their shares, either are unwilling or what have you. And the question is, what should the ESOP do? And again, we've got all of these S corporation issues running around, and we have fiduciary issues. It's certainly better for the ESOP from the point of view of its value to be in this tax-free 100% situation. So sometimes you really see the mixture of the threat of a freeze-out, which is essentially would be the idea that you'd force these individuals to sell, or should the ESOP be willing to pay a premium price to get to 100% ownership? And in reality, you really have to sort of educate everybody as to the best interest of all. And sometimes what we see is the small shareholders exchanging their outstanding stock for some mixture of notes and instruments that give them warrants or synthetic equity that's not outstanding, rather than having outstanding stock. So we get the best of both worlds. We have the 100% ESOP ownership for tax purposes, but these folks continuing to have some carried interest in the company if it does well. The other interesting situation we sometimes run across is when we have ESOPs that are very old, where there's been minority ownership for ESOP ownership for a long time, or even majority ESOP ownership for a long time, and now we're going to 100%, but we discover that a lot of our ownership is really in the hands of terminated or retired people who don't work here anymore. We have a lot of our company owned by people who used to work for us and have earned their benefit, but are now shareholders who aren't active in the company. And what are we going to do to make sure that we've got more of the ownership in active folks' hands than inactive folks' hands? And there we have the possibility of using some sort of a buyback program or some sort of a re-leveraging of the ESOP to create a bunch of shares to allocate to new participants and to put cash in the hands of these terminated or retired participants. This is a variation of how do we create segregated accounts, how do we deal with the ownership of people who have left the company. And this does come up often as a planning consideration, either at a low level of benefit funding and creating segregated accounts, or at a high level where we get to the level of looking at re-leveraging or having a significant transaction to cash out a bunch of these retired or terminated participants. So we're getting toward the end here. We're going to have some time for questions and comments, but a couple of basic observations for anybody who's out there looking at this. First of all, in a lot of ways, it's our view that second stage transactions are actually more complicated than initial transactions because we already have the ESOP as a shareholder, and because they're change of control transactions, and we're planning with a lot more variables and playing with a lot more issues than we typically play with in an initial transaction. And that to us basically says, if you were sort of saying, How do I pick my advisors? What do I do? Do I use independent fiduciaries? All of those. If you saved a bunch of money, you're focused on saving money the first time around, it's probably more critical the second time around than the first time around to look at better or best-in-class advisors, to look at the formality of having independent fiduciaries, to look at having real boards of directors, essentially to do a bunch of things, not because they're simply insurance policies, but because you really want to maximize and optimize what's going to happen in this second stage transaction, because it's a pretty critical transaction both for the selling shareholders and for the companies. And the last piece here, and again, Whitey brought it up earlier, you've really got multiple stakeholders with perhaps different goals and visions. You have individual shareholders, you have the ESOP already as a shareholder, you may have a board that feels a little betwixt and between, and you have a management group that is now seeing themselves as the new dominant folks in the company and who are really focused on this transition process, both from the point of view of how do they satisfy the individuals, shareholders who they were hired by, how do they make sure the transaction works for the ESOP, and also how do they maximize their own self-interest, which may be a mixture of role and compensation. And so you've got multiple stakeholders with multiple goals, different goals and visions. These are things that are best done with a lot of very explicit discussion about what people are thinking and what their roles are. So, because the place where these things tend to go badly is when people are not clear about what their goals are and not clear about what their interests are and are trying to play multiple roles and wear multiple hats. With that, I'm actually going to unmute the piece here, and people can actually ask questions verbally. I'll just hope that people are relatively quiet in the background as we do this.
The conference has been unmuted.
And Bill has a question here. Have you seen many S-Corp companies with accumulated cash use direct loans to the ESOP as a message for addressing diversification and repurchase obligations? And the answer is no, I haven't. Seems like it's theoretically a possibility, but the problem here is that the exempt loan rules really contemplate a purchase of stock from a third party, not or from the company, not a loan to the ESOP to deal with diversification and repurchase, unless we've actually distributed the stock already and are trying to buy it back from folks. Any other questions or comments? All right, we're done a few minutes early unless anybody wants to jump in. Appreciate everybody's time and attention. Anybody has anything after the fact, feel free to email me. And as I said, this is going to be available on the web, I believe, as can be replayed. There is one last question written here. What do I think the political future of ESOP S Corporation status? My crystal ball's a touch cloudy. But in the absence of major tax legislation and tax reform where all things are up in the air, I'm not really aware of anything specific out there now that's being taken seriously that would impair this. So I think we're looking at this world, at least for a good while longer, of the S Corporation ESOP as a tax-free benefit. So again, thanks to all. Feel free to call, email if you have any further questions or comments. Have a great day. Bye-bye.
Thank you. Please stand by.
Premiumbeat.com